This week on the podcast, have you ever wondered what an SPV is and when and how you should be using them? Welcome to the Profit Cash Growth Podcast. This is the podcast for 6 and 7 figure business owners who are looking to grow a financially successful business. My co-host, Claire Hancock, is a finance director, chartered accountant and entrepreneur. And every week, I'll be exploring guidance and frameworks designed to help you increase your profits, improve your cash flow and grow your business. So I think we're now in the actual countdown to Christmas, aren't we, Claire?
Oh, sorry, I didn't realise we'd start the podcast then. I was just on my phone. Hang on a sec.
So, yeah.
The what?
The
You just said
countdown to
the C
Christmas.
word.
We're pretty much there, aren't we?
To be
The
fair,
shops
for
are full of
us,
it,
it is, because we go to Tenerife for December, don't we? So for us, really, Christmas starts at the end of November. Well, I say the Christmas break for us anyway.
Yeah.
So, yeah, we've got 5 weeks until we jet off to eternal sunshine.
Not that we do anything but work there, but at least it's warmer.
It is warmer, yeah.
That's the good point. Yeah, the thing I like the most is party food. You know,
You know, little picking blanket, don't you?
pigs and blankets,
Yeah.
all this stuff comes out and it comes out so early and then I can just start. Also, the turkey feast sandwiches, like the sandwich selection for lunch as
a
well, gets
Christmas
really
sandwich,
good. Doesn't it get
yeah.
good? Like M&S's
Greg's do a
one,
good one.
Greg's do a good one. I love all that stuff. It just, the problem is, like, by the time you get to Christmas, I'm so bored of it because I've like just made it part of my routine. I think they do, like, they make it too long, don't they? It doesn't become special. I'm reading a good book at the moment. Morgan Housel, he's like really fair. He did the psychology money that's always in the charts, like number 2, whatever it is. He's just launched a new book called The Art of Spending Money, and it's really interesting. It's all about like how to spend your money well, like to maximize your happiness and things like that. And that talks a lot about, we say this, don't we? Like when you find something and you just like milk it to death, and then after you've done it, we do this a lot when we find something nice to eat in Waitrose, and I'm like, we have it for dinner like 3 weeks in a row, and then I'm like, we never have it again, so I just get bored of it. And it's that thing of like, he sort of says that just because you can doesn't mean you should,
Yeah.
because you just lose that enjoyment sort of factor. So you got anything going on, Claire, you want to talk about other than Christmas and snacks? No?
No, not really.
Should we just crack straight on? Let's move on to this week's news story of the week then. So this week, Claire, the headline is UK's world-beating minimum wage poses problems for business. And this was interesting because it really puts into context. We know that policy has pushed up on minimum wage, and that is a good thing, I guess. Is that a good thing? Because now people have a basic level of income, which is now £25,396 a year. That's £12.21. However, that's now made Britain one of the highest minimum wage places in the world. And British workers over the age of 21 and 12-21 equate to the salary of £25,397, which is now more than those in Germany, France, Spain, America, Canada, Japan, Australia and New Zealand. The only minimum wage workers that are more than us now are in Luxembourg, Iceland and the Netherlands.
It's staggering, isn't it? Now, interestingly,
And when we talk, just...
I thought that you were actually going to talk about a different news story when
Right.
I saw it was minimum wage, and it's that she's suggesting that it goes up again.
It's almost definitely baked in. It's going to come out in the budget, I think, that her advisors have suggested a minimum increase of 4%, but they're actually suggesting more practically that it goes up slightly more to £12.80 as a minimum. So don't be surprised when the budget comes that a minimum wage goes up from £12.21 to about £12.80. The minimum it's probably going up to is £12.65. So it's going to be another 4% hike this year. So that's going to really take it to new heights. So, and I'd almost forgot about the push of minimum wage for businesses, because obviously there's lots of other things that they're talking about again in the budget this year that are making things more difficult. But I think one of the most painful things last year for most businesses, I understand, probably wasn't the national insurance rise, but actually the minimum wage rise, wasn't it?
Yeah.
And that's what's probably killed a lot of these businesses, you know, the Pizza Huts of the world and people that like rely on that type of labour, because it's so difficult to pass on. I mean, it's just purely inflationary, isn't it? Because you purely pass that on as a business offering those type of services generally. So I guess we're going to have another whole year next year of 4% inflation. I think 4% is going to become kind of the norm with inflation. I think I can't see that changing. Great if you if you own assets that are linked to inflation, terrible. If you're a normal working person, they're trying to protect, obviously, but gone off on a tangent here.
What's really become quite staggering, and we've seen this in our business, like we typically in accounting, you would have your qualified people, you'd have your people that are studying. Why are you gasping?
Sorry, I'm just carry on reading this. It talks about how much as a percentage it is higher than the minimum wages in these countries. Did you know it's 80% higher than in Spain? 80%,
that's staggering, isn't it?
Wow.
So typically in an accountancy firm, you'd have your qualified people, you'd have your people that are studying to become qualified, and then you'd have normally like an admin office junior person who, is typically like a school leaver or somebody entering not on like a traditional apprenticeship, but you would refer to them as an apprentice, and they would be really just starting out in their accounting studies. That role now is completely priced out. There is absolutely no way on this earth that I'm paying 25 grand to somebody that has got pretty much no office experience, no world experience, no business experience, let alone no accounting experience, to sit there and do admin and drain my team's time to train them. We're much happier paying 30 grand and getting somebody that's got 3-4 years experience behind them. And it is staggering how damaging this is to the very people that it claims to be helping.
Interesting. I hadn't thought about that, but you're absolutely right. What they've done is they've taken a rung out the ladder. And the reason that's just resonated with me massively, because this is what they've done in the housing market as well. They've taken a number of rungs out the ladder, and they've done it through taxation and stamp duty and cost of moving in the housing market, where an average first time buyer now buys a 3-bed semi.
Yeah, not a
one-bed flat, followed by a 2-bed terrace, followed by the 3-bed semi. They just wait 10 years longer and then buy the 3-bed semi because it's so expensive through taxation and policy. And that is you're exactly right. It's what they're doing here. I've never thought about that. That actually all they do is they just make those bottom 11 jobs disappear.
Yeah.
Because the gap, we know the stats tell us that average wages as an average, while they're tracking broadly inflation, they're okay.
They're not tracking like national minimum wages, though.
National minimum wage is flying high. So we've talked about, we did a whole podcast on the squeeze gap between the two that I think will continue. So you just end up with this situation where those type of roles just don't exist anymore.
I think as employers
and
as
for
well.
everyone else, you just pay more for the service, because if you need a cleaner, you need a cleaner. So that's just inflationary, and that just goes on to the consumer, doesn't it?
As an employer as well, it's made me far less tolerant of somebody that isn't quite cutting the mustard.
What are you suggesting? You were previously tolerant?
I think previously, if I had somebody on, 20 grand a year, my expectations would have been lower for them, for one. But now, the minimum salary that we have somebody in our organisation on is 30k. Which is a lot of bloody money every month for somebody to not be cutting the mustard. So from that perspective, it's like even the people that we expect the least of, now the expectations have been raised because of the cost going up and up.
What about somebody who has the really hard you are your own economy attitude that says to you, Claire, then that's your problem because you just aren't charging enough to your customers. So just structure your business right so it can fund people at this level?
You are completely right, but because it's not about the cost, because absolutely we do this type of service and the type of organisation that we serve, we are not necessarily competing with loads of people on price. If you want a tax return done, there's a million accountants out there that can do a tax return. If you want what we do, it's a bit more niche, and so therefore our prices, we do have a bit more flexibility and the luxury of being able to put increases in and charge the appropriate rate. But it's around that risk element of when I take somebody on, it's what mindset do I have towards them? Immediately I'm thinking this person's costing me £3,000 a month.
Yeah, it's frightening from day one, isn't it?
And that's a very different mindset to this person's costing me £1,500 a month. When they're costing me £3,000 a month, it's if they're not hitting X, Y, and Z by the end of week 2, they're gone out of my business. If they're not hitting A, B, and C by the end of week 4, they're gone out of the business. And it's very much like from day one, we're much fussier in the recruitment process. We take less risks on people, and we're much more brutal, I think is the only way to describe it, in terms of letting people go when they're not hitting those, because there is no room to have anything but brilliant at the price point that you're paying. And I also think that looking at people that, for example, might be on some of these minimum wage jobs in hospitality or warehousing, some of these maybe unskilled minimum wage jobs, looking to hopefully move on in their life and maybe move into an office environment and start a career, that jump is now too great.
I agree, yeah.
Because you could have swapped a minimum wage warehouse job for a minimum wage office job before, but now there's far, far less around. You have to swap a minimum wage warehouse job for a 30k a year skilled office role.
What about the argument that doesn't this make getting off welfare worthwhile now?
Well, this is the argument, isn't it? It's like that Labour have been very clear that saying that they've got to make work pay.
But they're pushing welfare up by the same sort of inflationary numbers anyway, so aren't they?
Yeah,
they generally put that up by 4%.
Welfare's going up. And there are people out there on welfare that get 25k net.
Well, yeah, they do.
That's the other thing.
Because they don't pay tax on it. I know.
So there are loads and loads of households on welfare that are still taking home more money because of the way that the welfare system works. So honestly, I think based on where we are in the economy, the actual proper solution for this is to cut welfare, not to keep pushing that national minimum wage up, because they're damaging the very people that they claim to be helping. They're trapping them in unskilled minimum wage jobs.
Yeah. This is going to be interesting. It really is. Do you want some fun stats as well out of this?
Is there anything fun about this?
There's some fun stats. Well, there's some. Well, first of all, what has the UK minimum wage increase been in percentage terms over the last 5 years?
30%?
40. So it's gone up 40% in the 5 years, because it was 8.72 in 2020. So it was just 8.72 in 2020. It's going to be 12.80 this. That's enormous.
That's
it's amazing.
Staggering.
Although inflation's not been small over that time, it's been 28% over that time. So, yes, it's a lot more than inflation, but inflation's been pretty heavy, as we know.
But what's pushing inflation?
Yeah, more wages.
Yeah.
Here's a fun one for you then. So, of the 153 countries, some of the lowest. So, this is just how far. And I know it's not relative, but the minimum wage in Afghanistan per year?
Don't know.
£765. So we're £25,000. They're £765.
Okay.
So we're nearly 26.
Afghanistan, not a good example.
No, Nigeria.
Why are you choosing some of the
£404 a year, and Bangladesh 910. So you wonder why the label in every one of your pieces of clothing says made in Bangladesh at £910 a year versus £25,000 a year in this country. Is it any wonder that everything's made in Bangladesh? You know, it's just the commercially astute and right thing to do, isn't it? I guess, for business.
Yeah, you know,
fascinating.
In our organisation, we've never outsourced things. We've always employed people. And when my new practice manager, Chris, joined us a couple of months ago, and he was saying that in his last organisation, they basically, it was him and one other person in the UK, and everything was outsourced to India. And they paid on average £6,000 a year for an Indian fully qualified accountant. And at the moment in the UK, that wage is pushing 50k.
Yeah.
So just to put some perspective on
that is the other things we see. Well, this certainly incentivises outsourcing, but has done for years. That's why so much stuff is outsourced and overseas, but really pushes AI, doesn't it? Because again, if you can AI it rather than, labour it, you can understand how that just pushes that agenda rather than helps that agenda. So I don't know. We'll see more about that anyway. Great. Call me Robert Peston, eh?
Okay.
In my current affairs. All right, Rob. Let's move on to this week's deep dive, where we're talking about SPVs. So, Clay, you're going to break the truth about SPVs today, aren't you? When we should use one and when we should run a mile. Why are we talking about SPVs, and what even is an SPV?
Well, I think you've hit the nail on the head there. I feel like SPVs is one of these things that's become very trendy. Certainly, if you're looking at buying businesses, buying property, everybody's talking about SPVs. It's on the lips of any sort of business guru, so-called guru. Well, I'll get to that in a second. But also, a couple of people in my team have been asking this, because we've got some situations going on with our clients at the moment where they're using SPVs, and a couple of the team members were like, what is an SPV? And I thought there's a lot of sort of misconception about these. So let's just cover off exactly what they are, what it means, when you can use them, and what you've got to watch out for.
We're going to bust the myths and smash the bangs, yeah? Okay. You're going to answer, you're going to...
Well, you're going to ask the question again, so people know what I'm saying.
You're going to answer my first question, aren't you?
Which is,
what is an SPV?
Well, SPV stands for Special Purpose Vehicle. But actually, it would probably surprise people to mean that it actually means nothing. From a legal perspective, from an accounting perspective, from a company perspective, it just doesn't mean anything.
What do you mean?
It's got no legal basis in any tax, accounting law or anything. SPV is just a term that people have coined to refer to something.
Okay, so it's not actually called this. It's just somebody's put this wrapper around it.
It's not a thing. It just means it's a limited company.
Okay.
It doesn't mean anything. What people generally mean is that you set up a company just to do one specific thing. Yeah. So you've set up a company just for the purpose of buying the shares in another business, or just for buying a rental property, or just for buying commercial property. But it doesn't actually mean anything. Because if you think about, my accountancy firm, I've set up a business just to run an accountancy firm. It doesn't make it an SPV.
No.
So
we don't refer to normal businesses as SPVs.
Exactly. So an SPV doesn't actually mean anything from a legal perspective. It's just a term that has become quite well known in the industry?
It was actually coined, the special purpose vehicle term came from the finance and legal worlds in the 70s and 80s when investment banks started inventing ever more creative ways to shift risk off their balance sheets, apparently.
Yeah.
There you go.
So when do we see SPVs most commonly referred to or most commonly used? And that's when you're buying property, buying a business, or pensions. They're kind of probably the three reasons why somebody uses it. And it's probably 99% of scenarios will fall into one of those: buying a business, buying property, or pensions. Okay.
Yeah, I guess it's a fair point, isn't it? We have a limited company for our properties, but and everyone calls them SPVs, or they refer to them as tax wrappers.
Yeah, or holding companies
ways,
also is sometimes how it can be used.
Now, I didn't know that the whole term of SPV really blew up because of the Enron scandal. Did you know that? No. Apparently that's where it brought it to the forefront. Apparently that was part of them.
So we're not going to talk about pensions because we don't offer pensions advice, and I think we're treading on slightly murky water with that. But what we're going to do is we're going to cover when you can use it to buy property and when you can use it to buy a business and what you need to look out for in each scenario. So we're going to start with property. So whether you're buying buy-to-let property as in like rentals, or whether you're buying commercial property, be it your own commercial property that you're putting in a separate company to your trading company, or be it that you're buying commercial property as an investment, typically people will set up an SPV, which essentially just means that you're setting up a limited company with a very specific purpose, i.e. you're going to do nothing but hold property in it. Mm-hmm. That's all that means.
Yeah.
Now, the main reason why people buy property through an SPV is normally around risk, because you're basically ring fencing your assets into a limited company, which means that should something go wrong with any of your other businesses, it's pretty protected. The bank generally can't come after it.
Yeah.
Although you do have to be careful, because often with personal guarantees and things like that, you can sign waivers so they can go after any assets, etc., etc. So it's not a strict rule, but that's generally the consensus and why people do it.
The other reason that people do it from a property perspective is around lending, isn't it?
Yeah, I was just about to come on to that. Yeah. So often particularly if you're getting mortgages for buy-to-let property, the lenders will specify that the property must be held in an SPV that has a specific SIC code. That's an SIC code. And that SIC code appears on Companies House. And it just essentially is the purpose of why that organisation exists. So as an accounting firm, we have a SIC code for accounting. If you're an electrical company, you have a SIC code for electricals. And if you're a property investment company, you have a SIC code for property investment. And for them to issue a mortgage, your company must have the right SIC code.
Correct. Now, it doesn't mean that you can't get lending if you hold a property in a trading company. But I know from experience, just to share with the listeners, it's harder. So your choices are very limited. But most importantly, you're going to pay a much higher interest rate because you're classed as higher risk for all the reasons you just said, versus having an SPV where your risk is lower. So therefore, the lenders like it more. So that's why you do it.
Because if you think about this from like a lender's perspective, if you have a trading company mixed in with some property as well, and something goes wrong with the trading company, then potentially the bank could you would default on your mortgage, and therefore would the bank get repaid? It becomes much more murky when you've got lots of potential finance agreements, lots of potential creditors mixed into it. Whereas if you've just got these properties sitting alone in an SPV, if you go under, it's very clear the bank gets the property, end of.
Yes.
It's black and white. There's no employees, there's no redundancy to worry about, there's no potential taking, other creditors that might be allowed to be paid out before you, etc., etc. Yeah. So that's the reason why SPVs are generally preferred from a risk perspective when it comes to financing and lending and things like that.
It's just clean.
Yeah, it's nice and clean. And, you have one mortgage tied to one property, end of.
So that's where we would use it from a purchasing property perspective.
Yes.
What else would we use SPVs for?
Buying businesses. Okay.
Yeah. So you set them up specifically to start that process?
You would set up an SPV with the aim that the SPV buys the shares in the business that you're purchasing. So if you're purchasing Smith Sons electrical contractors, you would set up an SPV, call it SPV Holding Company 1, and it would buy the shares of the business that you're purchasing.
Okay. So why would we do that?
Now, this is a very, very good question. So firstly, I'm actually going to deviate a little bit, but it sort of explains the main reason why people use SPVs.
Can you tell a story?
I am working on an acquisition at the moment. I'm acting for the seller. And we had the SPA through, which is the share purchase agreement, and it had the buyer and the seller listed at the top. And I clocked that the buyer was a personal person. It was the individual, not a limited company.
Yeah.
And there's some deferred consideration with this deal, which is why I flagged it. Normally, I would say it's up to the buyer to get their own tax advice.
What's deferred consideration?
When somebody isn't paying the full purchase price up front, they're paying it over 3 years.
Okay, so the business needs to remain trading,
remain solvent,
to give
exactly.
purchase back to the vendor.
And the reason why I raised this is because there was quite a considerable amount of deferred consideration, and I raised it because the person buying the shares personally, they essentially have to use their own personal money to buy those shares.
Okay.
So where that money comes from could be anything. It could be mortgages, it could be loans, it could be friends and family. But most likely, they're going to need to take dividend or salary out of the business, pay tax on it, and then use post-tax income to pay the seller.
Okay.
And that's just really not a very tax efficient thing to do. And in this particular deal, it meant that there was deferred consideration, I think, of roughly about 400k on this deal. And so that meant that this person would need to take out nearly 750k of dividends or salary in order to pay the tax and then have enough left to pay the seller. And I just felt that this was actually significant enough that I had to flag it and say, you're getting really bad financial advice here because you should not be structuring the deal in this way.
Okay.
You absolutely shouldn't do it because it just, there just wasn't enough cash there. And I think it meant that my seller would never have got their deferred consideration.
And this is exactly why they commonly refer to them as tax wrappers.
Exactly.
Yeah.
So if you instead buy the shares through an SPV, then the trading company who actually has got all the cash in the bank, your SPV hasn't got any money, has it? It's just a new limited company that we set up. Where's that money coming from? Well, you can do an intercompany loan from the trading company up to the SPV.
Yeah.
It can be interest-free or you can charge interest. You can have repayment terms or no repayment terms. Often what we'll find is that there'll be just this chunk of money transferred. So in this instance, it's 400k deferred consideration. The trading company will transfer that money into the SPV and the SPV can then pay off the seller.
Excellent.
And that transaction, that loan, becomes completely tax-free. There's no tax implications on the individual. And the beauty of it is that the individual still owns 100% shareholding of the SPV.
Okay. Yeah.
So they still own, essentially, through the structure, they still own 100% of it. They've still got the same asset value. It's just you put this SPV in between. So you've got personal individual, SPV, trading company.
Got it. Yeah.
Are you sure you've got it? You're looking at me a little bit.
No, I'm just thinking, how do people use this information? Because they're going to fall into three camps that are listening to this, aren't they? They're going to fall into, they've not yet bought, so great that I've got all this information because I can start fresh. I can start right from the beginning and get the right advice. I'm in the middle of buying and I hadn't heard of this and I'm doing it the wrong way. How do I get out of that? And then I've bought the wrong way. Tough luck, I can't do anything about it now. So is there ways to help the people in the middle bit that are like, I've just realised I'm halfway through this and I'm doing this wrong?
Yeah, I mean, in terms of if you're going through a deal at the moment and you're purchasing, then just ask for the SPA to be changed. Yeah. Ask for the, from our perspective,
so they can rescue it.
You can rescue it.
So in the middle of it.
The difference is, from the seller's perspective, the seller ideally wants the individual to be buying the business because then the buyer, the individual, has taken on 100% of the guarantee in terms of any deferred consideration.
Right.
So that sits with the individual if they're the one that's named on the contract. However, you just ask for personal guarantees and you ask for warranties to make sure that should the SPV fail to pay the deferred consideration, we can go after the individual too. Okay. So it's a little bit more negotiation that you've got to do to make sure that's in the contract and that everybody's happy with the warranties. But that's just the really practical solution and the way that that's dealt with. That's very, very common. And if you've got a seller that will not sell to an SPV, then they're pretty much not realistic about selling their organisation. That's the reality.
Yeah, got it. Amazing. Brilliant. Anything else to add on SPVs?
Yes, so a couple of things. So another reason why we use SSE is... why we use an SPV. We've got lots of acronyms in this. Another reason why we use an SPV is because of something called SSE on the sale, and this is Substantial Shareholding Exemption. Okay. So if just say you bought a business personally yourself and you hold the shares in your own name, when you come to sell that business, you have to pay capital gains tax on it. Any gain on the sale of the shares you pay. But if the SPV wanted to sell the shares that it's purchased, maybe the business grows in a few years or it doesn't just fit with your portfolio anymore, you want to sell the shares, then you can sell the shares and there is no tax to pay.
Okay.
Subject to you meeting the requirements of using SSE, Substantial Shareholding Exemption. So how this can be really powerful is, say you bought a business for $1 million, over 5 years you turned it around and you were able to sell it back on for £2 million. You've then got £2 million sitting in your SPV. You don't have to pay any tax on that. And that means that you can then reinvest that money.
Okay. And between companies.
Yes. So you could then do intercompany loans. You could reinvest that money into something different. You get to keep 100% of those proceeds. Whereas if you own the shares personally yourself, when you come to sell them, you pay capital gains tax. And even if you wanted to make another investment, you've got to pay the capital gains tax, which means you've only got what's left to invest after tax.
Yeah.
However, the flip side of that is BADR doesn't apply.
Okay, which is Business Asset Disposal Relief, which is
old school entrepreneurs relief.
Allows you to only pay 10% tax on the first
now.
14.
Yeah, Rachel Reeves changed this and it's going to be aligned more to capital gains tax. So it's been staggered over the next few years that the rate's been increased. It was 10%, 14%, 18%, etc.
It used to be 10 million, now it's only $1 million.
No, it's only $1 million, yeah.
It's like dividend, it's everything. It's like everything's just disappearing.
And it's interesting because with BADR being reduced down, it's probably going to completely eradicate the need for anybody to want to hold shares personally. Right. However, the way to get around that BADR is you sell the SPV and the shares that it owns. You don't sell the trading company. So you can see how immediately complex this is. And if anybody's going to give you advice on whether you should or shouldn't buy a business through an SPV or not, they really need to be asking you, what are you planning on doing with this long term? Because if in 10 years' time your plan is to sell it and invest that money in a personal pension, that's probably going to be different advice to you saying to me, I want to build this business, I'm going to buy 5 more and I'm going to sell them all at different times and keep reinvesting that money in more and more businesses. That's a very different strategy to if you're wanting to sell and sail off into the sunset.
Great.
So, Simon, do you now know what an SPV is?
I know exactly what an SPV is. Thank you very much. It's actually nothing. To be honest with you, I've had one all along, but I didn't even realise I had one. I have a fairly substantial SPV, but I never called it that. I just call it Hancock Homes Limited.
Yeah.
Great. Perfect. No, I think I have no other questions on that. I think that's crystal clear and very useful. Thank you very much, Claire.
I'll make a shameless plug here and say that we do M&A work. So
you do M&A. You do quite a bit of M&A. You do it very well as well. You do it very well. It's not...
If you're on the sell side or the buy side, then do get in touch. We can help you just with the M&A deal. But of course, we'd love to start a working relationship and work with people long term.
Yes. I mean, what you do tend to find as you go through these is that they often need more financial support out the other end after they've bought it anyway. So, which is great because if you've got your feet into it during the M&A process, you really understand that business to be able to then help its finances out the other end, don't you, often? So that's useful. Great. Well, let's move on to this week's Profit Cash Growth Extra. So this week I just wanted to throw in a little one that I have started using this week just to manage our social media. So I've just been delegating some of our social media management out. And as part of that, I wanted a piece of software that could manage all of the different platforms and schedule out and post across all of them. But I wanted something that is really super simple. I did not want some complicated software. So I picked a piece of software called FeedHive. I think it's FeedHive.app or something like that. And it's just simple. It's fairly cheap. It costs about £19 a month or £16 a month if you buy a year's worth up front. It's just dead simple. I love simple software, dead chunky buttons. You write your posts, you create all your posts in one place, and then you just click the platform as you want it to go across. It connects across LinkedIn, TikTok, Instagram, Facebook, you name it, dead simple. And you can also schedule, so you can schedule out sort of 2-3 weeks in advance as well. And I just like it because it's simple and I like simple software and I'm a simple person. So that's it. So check it out, FeedHive, if you're looking for a nice, easy way to schedule your social media posts moving forward. And as always, if you feel like you might have outgrown your current accountant, you'd like to work with Claire and the team at Profit Cash Growth, go over to the website, profitcashgrowth.com. On there, you can book a free discovery call. You could order a copy of Claire's book, Profit by Numbers, totally free in the post if you're a UK resident. And as always, please rate, review and subscribe and share this episode with just one other business owner. And you never know, you might really have just saved them a load of cash. And we'll see you again next week.